Welcome back, people. So now we shall revise the financial instrument wala topic with the help of our chart book. Okay, financial instrument is a standard that covers the three indices: Ind AS 109, 32, and Ind AS 107. Okay, so let's get started. First, financial instrument means it's a contract. It's a contract that will either create a financial asset to one entity and financial liability or equity to one other entity. Meaning, if you want to call something as a financial instrument, it should arise as part of a contract. Something which doesn't arise as part of contract, meaning your income tax obligation or contractual obligation that arises as part of Ind AS 37 and all, they are not financial instruments. This contractual obligations or constructive obligation, you will study in Ind AS 37 later on. Do not worry about that for the time being. Okay, so they don't come as part of contract, so they are not financial instruments. Okay, the second one is financial asset. Financial asset means few components: cash including bank deposits, equity instruments of another entity, a contractual right to receive cash or any other financial asset, or to exchange a financial asset or financial liability under favorable condition, a non-derivative contract where you're receiving variable number of your own company ka equity shares. Last one is your derivative. Your property, plant and equipment, investment property, your intangible assets, etc., are not financial assets, because financial asset means something to do with cash. By holding these instruments, you don't get cash, you have to use them or sell them. Similarly, if you have given any advance to your staff, okay, if you're prepaid salary, you don't have contractual right to receive cash, you have a contractual right to receive service. So prepaid expenses are not financial assets. If you have given any loan to your creditors as an advance, then that is also not a financial asset, because you have a contractual right to receive goods and not cash. So then we saw financial liability. Financial liability is cut off first two features of a financial asset. There comes your financial liability ka definition. Yes. So here it is a contractual obligation to pay cash or any other financial asset, or exchange financial asset, financial liability under unfavorable condition. Non-derivative contract where you are giving your own company ka equity shares, but you can't show it as equity because fixed to fixed test is failing. Meaning, if you are receiving variable number of equity shares, or if the consideration is not fixed, then such equity shares issued will also be classified as a financial liability. The last element is your derivative. Yes, so this is your financial liability. Now next is equity. Equity means what, sir? It's an instrument which gives the holder the right over the net assets of the company. Okay, and equity instruments generally are non-putable. And on equity shares, we don't have any obligation to pay cash or financial assets, or for that matter, anything else. And if you want to show, or if you want to classify an instrument as equity, fixed to fixed test has to be satisfied. Meaning, how much consideration you're receiving has to be fixed. How much is the number of equity shares you're giving also should be fixed. That is one. However, if the number of shares is varying, if the number of shares that you're giving, if it's varying due to passage of time, or due to stock split, or due to passage, or due to foreign currency, then still you will say the fixed to fixed test is passed, and still the classification will be equity itself. Okay. All right. The next one is putable instruments. Putable instrument means it gives the right to whom? To the holder to sell the instrument back to the company. Generally, it will be shares. Okay. So if company has sold the shares with putable option, means that the guy who has purchased that putable instrument has a right, that holder has a right to sell the shares back to the company at a particular date at a particular price. Or it automatically gets put back, automatically gets sold back to the company on occurrence of certain remote events like death or retirement of a holder, etc. Putable instrument means we have an obligation. The company has he has a right to sell. So company has an obligation to pay the money when he sells. Since obligation is there, normal classification for putable instrument is financial liability. However, if putable instrument has certain features, then still you can go ahead and classify it as equity. What are those features? The holder of putable instrument should have a right over the net assets of the company. Okay, that is one. And second one is it should be subordinate, meaning it should rank last in the payment. So this putable instrument. And if you have multiple putable instruments, all of them should have identical features. Putable instrument means company already has one obligation, that is to pay cash. Other than this, some extra obligation to give some extra shares or other financial assets, or to give variable number of equity shares, etc., should not be there. Okay. Then the return of that putable instrument should be influenced. The return of equity shareholders are influenced only by two things, that is profit and change in net assets. Even putable instruments return should be only influenced by profit or change in net assets. If all of these are satisfied, then you can go ahead and classify putable instrument as equity. Otherwise, their classification will be financial liability. Okay, next is reclassification. Can you reclassify from financial liability to equity? Yeah, if you're going from financial liability to equity, equity does not have any obligation. So we need not use fair value. On the date of reclassification, whatever was the carrying amount of financial liability, equity ka carrying amount will be same. So basis will be carrying amount of financial liability here. Since you're using carrying amount, no gain or loss will come. However, if you're doing other way around, from equity, if you're going to financial liability has obligation. So if you have an obligation means you have to find out fair value. So this reclassification will be done using fair value on the date of reclassification, and due to this reclassification, you may get some gain or loss because equity is not shown at the fair value. It is shown at the initial value. So whatever gain loss you're getting, okay, this gain loss is related to equity. As a simple thumb rule is anything related to equity will be booked in equity itself. It will not come to SPL. Okay, that is one. Then put option. If you have written put option over NCI, you can write put option over NCI or anybody else, doesn't matter. Okay. So if company has written put option to somebody else, or if the holding company has written put option over subsidiary shares with NCI, we have seen a couple of problems. In that case, what to do is what I've received. Normally in put option, we will receive some premium. So premium received, you accounted in a P&L? No, it will be recorded in equity itself because it is related to equity. The journal entry will pass as bank account debit to equity. That's what I've called out over here. Okay. So if premium received will be recorded through equity itself. And then record financial liability. Since we have an obligation, because we have written put option means holder has a right to sell. If holder has a right to sell, we the writers of that put option have an obligation to pay. Since we have an obligation to pay, we have to record financial liability at what? The present value of the outflow expected. Okay, I recorded at that. Okay, so the journal entry to record it is the financial liability you need to create. So the journal entry will be equity account debit to financial liability. Put option means name itself is saying option. So you can utilize that option and exercise, or option may get lapsed also. If option gets exercised, meaning if the holder sells it, then we as a writer should pay the money. So we have to settle that financial obligation. So the journal entry will be financial liability to bank if it gets exercised. If it gets lapsed means we have already recorded obligation. Since it's lapsed, we don't have that obligation anymore. So reverse the obligation. To create the obligation, we wrote equity to financial liability. To reverse it, reversal entry, financial liability to equity. This put option, though I've written it over NCI in the chart, it could be written over by the company to normal shareholders, or by holding company, they can write a put over NCI. We have done problems based on this. Okay. All right. Next is compound financial instrument. Compound financial instrument are those instruments which has features of both financial liability and equity. That means what we have to do? We have to do separate. How do you separate? How do you find out financial liability? Financial liability ka value we found out by finding the fair value. And how do you get that fair value? By finding present value of future cash flows. Find out the present value of future cash flows expected by discounting at the original rate, not at the contract rate. They would have given you the market rate, discounted using the market rate, and find out the present value of cash flows. So there will be a difference. Transaction price would have happened at 10 lakh rupees. While discounting the present cash flow, you may get only 8 lakh. So this is your transaction price. This represents your financial liability portion. The difference between the transaction price and the financial liability, here in this example 2 lakh, will represent your equity portion. For equity portion, there is no subsequent remeasurement. For financial liability, you go for ACM accounting. That's all. Okay. And ACM table accounting, you book the interest using the effective interest rate. Okay, that's what I've told. And if this compound financial instrument on you settle, on the settlement stage, if it is redeemed means we already have a liability, that liability is settled. So the journal entry will be liability account debit to bank account. Fine. That is one. Suppose if it is converted, into equity, that means no more we have obligation. So debit the financial liability. So we'll write financial liability account debit. Initially, when we recorded compound financial instrument, we had parked it in equity or other equity. That also you debit. Now you give actual equity shares, no? Credit equity share capital to the extent of face value. Balance will go off to security premium account. That entry. Just don't show a separate entry. You can do a compound entry. This is what we have done it in our problems. Okay. So this is your compound journal entry ka end-to-end accounting that I brought it in the charts. All right. Next is treasury shares. Treasury shares means if company buys their own shares. So this is basically a buyback accounting. So if company buys their own shares, can we show it in India as a financial asset? No, in India, you cannot show that as a financial asset. So that means you'll do all this transaction in equity itself. So to do buyback accounting, if you have received any premium, we had seen in one problem. So this company had written put option, they had received premium on this. So if you have received any premium means that premium will be recorded in equity itself. The journal entry will be bank account debit to equity. The simple thumb rule, if you're doing any buyback accounting and if you're getting any gain loss, because buyback could happen at whatever price, no? So if you're getting any gain loss, that gain loss will never come to SPL. It will always be recorded in equity itself. Okay. All right. Next, interest dividend loss gain. If you're classifying an instrument as a financial liability, then it doesn't matter what you're calling it, whether you're paying dividend, whether you're paying interest, whatever name you call it. If the instrument is classified as financial liability, means that whatever you're paying will be accounted in SPL itself. Okay. However, if an instrument is classified as equity, you can pay dividend on it, you can pay interest on it, whatever name you call it, name is irrelevant. If it is classified as equity, means anything that you pay on it will be recorded in equity itself. That's the thing. Okay. Then transaction cost. If you have any transaction cost on equity, when issuing equity shares, if you are incurred any transaction cost, that will be deducted from equity itself. Equity here refers to other equity. If you have any compound financial instruments, and while issuing compound financial instruments, if you incurred any transaction cost, then the transaction cost has to be split between financial liability and equity in their initial recognition ratio. Like in the previous problem, our initial recognition ratio was 8 lakh and 2 lakh, no? So in the 4:1 ratio, this transaction cost will be split in this particular example, like that. Okay, next is offsetting financial assets with financial liability. Can you offset financial asset with financial liability? Yes, you should have a legal enforceable right to do so. And you should have an intention to set off. Both right should be there and intention should also be there. I've given you an example. Creditor was at 10 lakh. We're planning to endorse bill receivable worth 9 lakh. Since you're planning to endorse bill receivable to creditor, bill receivable is a financial asset. Creditor is a financial liability. You can net them off because you want to settle on a net basis and show only creditors at balancing figure. 10 lakh minus 9 lakh, which will be 1 lakh rupees, like that. Okay, next is financial assets. If you have financial assets, there are three methods using which you can measure this financial assets for. One is amortized cost method, ACM method. Another one is FVT OCI method. Another one is FVTPL method. Amortized cost method, what do you have to do? If you want to go for amortized cost method, means there are two tests that it should pass. One is your business model test. Another one is your contractual cash flow test. The business model for ACM is you should hold that financial asset till its maturity and collect the contractual cash flows. The business model should be to hold it till maturity and collect the cash flows. And what does the CCF test say? CCF is a contractual cash flow test. It says the cash flows should arise on a specific date and it should represent SPPI, sole payment of principal and interest. And it should also be consistent with your basic lending arrangement. Okay. All right. That is what it is. So if these two are satisfied, means you can go for ACM method. If your business model is not to hold till maturity, if it's satisfied both by holding and selling, then you will go for FVT OCI method. See, even for FVT OCI, contractual cash flow is the same, no change. FVTPL method is a residual method. If you can't go for ACM or FVT OCI method, then you will account it under FVTPL method. That's all. Under FVTPL method, what do? Such assets at every reporting period will be recorded at fair value, and any fair value gain loss will go off to SPL itself. If you're going for FVT, maybe I'll do that a little later. All right, next, contractual cash flow characteristics. CCF characteristic is what? We told it should represent SPPI and it should be consistent with a basic lending arrangement. When you go for basic and lending arrangement, what are the parameters that will be kept in mind? You will keep the time value of money in concept. You will keep the default risk, credit risk, liquidity risk, etc., etc. You may link the interest rate based on the inflation, but it should not be leveraged. 1.5 times the inflation rate, like that and all you cannot do. If you want to link it with inflation rate, consumer price index and all, it is fine. But if you're linking with equity index, if you're linking with EPS, profit after tax, that is not. In that case, CCF test will fail. Yes, no? How? And if you're doing an inverse in linkage, if you're linking with inflation, that is okay. But if you're doing inverse linkage, meaning if inflation increases by 1%, interest rate will be decreased by 1%. That sort of inverse linking and all is not permissible. If you're doing inverse linking, CCF test will fail. All these are problem specific adjustment. I brought it in. Okay. Then transaction cost, if you have that you incurred on financial asset, what do you have to do? That depends on the method. If you're going for ACM method and FVT OCI method, then the transaction cost will be added, meaning it will be capitalized, added to the cost of financial asset itself. That after adding, I'm calling that as RTP, revised test price, but revised transaction price. However, if you're following FVTPL method, then transaction cost will not be capitalized, rather it will go off to SPL account. All right. Then initial measurement of financial asset. How will you initially recognize? That depends on how have you done the transaction. If you have done the transaction at market terms, then transaction price itself reflects fair value and you can record initial financial asset at transaction price itself. And if there is any transaction cost, add it. That's what I've said, use RTP. Meaning transaction cost under these two methods are added. No, after adding transaction cost, whatever value you get, that itself you can record as initial value of financial asset. However, if the transaction is done at off market terms, then you have to record, you can't use transaction price, we have to find out fair value. And how do you normally find out that fair value? present value of future cash flows discounted at market rate. Okay, so that means there'll be a difference. They say the difference is due to level 1 input or valuation techniques. That difference will go off to SPL. In all other cases, the difference, if you can recognize that difference as an asset as per any other standard, if we had done one problem on leases, right? We had taken a container on lease, so the difference we recognized as an ROU. If you can't recognize as an asset as per any other standard, you recognize it as a prepaid expense and amortize it as amortized to SPL over that contract duration. That is the off-market transaction ka duty. Then subsequent measurement, how do you go for financial asset? If you're going for ACM method, subsequent accounting is done as per that unwinding of interest or ACM table. You book the ACM table, you know the format, right? Year, opening balance, finance charges, you'll book it using the effective interest rate. Then repayment. In case of financial liability, there will be repayment. In case of financial asset, there will be a receipt. And lastly will be your closing balance. So go on booking finance income in case of financial asset at effective interest rate and go on booking. That particular table, ACM table will give you the interest income on financial asset every year and also financial asset ka closing balance, which has to be shown in the balance sheet. That's what I've written over here. All right. FBT OCI method, if you're following, means every reporting period, measure it at fair value. And if you're getting any fair value gain or loss, that will go off to OCI account. Okay, that's one thing. All right. Then one more point here. In fact, I told you this also. First, check if you're using FBT OCI method. If you're using FBT OCI method for debt, if you're using FBT OCI method for debt or equity financial asset, debt financial asset. If you are going for this one, no, then fair value gain loss will go to OCI. But on this debt, no, if you're getting any dividend or interest, that will go to SPL. Okay. And when you sell this debt, if you make any gain loss, that will also go off to SPL. However, for equity financial assets, the default category is FVTPL method because it fails the CCF test. But there is an irrevocable option. If you're using irrevocable option, then any fair value gain loss will go to OCI. Any gain loss on sale, if you sell this instrument, even that gain loss will go to OCI. However, dividend or interest, if you have received on that instrument, only that will go off to SPL. That is what I've called out over here. All right. This is one thing with respect to the debt instruments. All right. Then is FVTPL method, which is similar. Again, measure the instrument at fair value and any fair value gain or loss that you're getting goes off to SPL. Here, every gain loss will go off to SPL. Fair value gain loss goes to SPL. Any interest dividend received on that instrument goes off to SPL. If you sell this instrument and if you are getting any gain loss, that also goes off to SPL. That's what we have called out over here. All right. Next is financial liability measurement. Financial liabilities we don't sell. So FVT OCI method is ruled out. So only two method remains is your ACM method and FVTPL method. Okay, and ACM method is generally applicable for most of the financial asset that you can say as a default category. Okay, can you reclassify from ACM to FVTPL? No, that is not. Reclassification provisions are not allowed. Can you reclassify financial assets? Yes, there could be 6 particular combination is available or it's applicable. If the one simple thumb rule you have to keep for reclassification is, for reclassification we use fair value, and whichever category you are jumping to, the gain loss will be booked to that particular category. Okay, but before that, if you want to reclassify, that reclassification provisions should be infrequent. Every time you can't do that. Okay, so it has to be a benchmark. Maybe once in a while, okay, frequently not possible, and it's always done prospective accounting. So if you're going from ACM to FVTPL category, thumb rule is use the fair value on the date of reclassification. Any gain loss, if you're moving into FVTPL category, so book the gain loss in FVTPL itself. If you're going from ACM to FVT OCI category, use the fair value meaning the asset will be henceforth booked on fair value on the date of reclassification. You're jumping into FVT OCI category, so gain loss will go to OCI. If you're going from FVTPL to ACM, use again fair value on the date of reclassification, gain loss, transfer it off to ACM means again there's no ACM category, put it to SPL itself. However, if you're going from FVTPL to FVT OCI, use the fair value on the date of reclassification, but gain loss will not go to OCI, it will be transferred to SPL only. Okay, because these are debt financial assets. Debt financial assets at the end when debt financial assets, these are reclassifiable gain. So whatever OCI balance you have, that will be eventually get transferred to SPL itself. That is the reason they've taken an exception and saying gain loss don't transfer it to OCI, transfer it off to SPL itself. Then there are 2 exception rules. If you are moving out of OCI category, if you're going away from FVT OCI category, meaning FVT OCI to ACM category, if you're going, first rule is here also you have to use fair value on the date of reclassification only, but whatever gain or loss that you've booked in OCI so far, that you need to reverse. Here that reversal will happen or through the financial asset, meaning if you booked the loss means the journal entry you will pass, OCI account debit to financial asset account you will pass. Whatever gain you booked or loss you booked, you will reverse it. When you reverse the loss, financial asset will come back to its original cost. So the reclassification will be done at the original value itself. Okay, so ACM you have to apply from the beginning there in this method. If you're going from FVT OCI to FVTP category, then whatever gain loss you booked in OCI, that you need to reverse. That reversal will now happen through SPL. So if you booked a loss, the journal entry will pass as loss you would have debited. Now you need to credit. So the journal entry will be SPL account debit to FVT OCI. That reversal will happen. So bond account will not get affected. So you will do this reclassification on this reclassification will happen at the fair value on the date of reclassification itself. Okay, this is your reclassification rules. Then we studied impairment. Impairment means some reduction in the value of which only financial assets. Financial liabilities and equity are not impaired. When we talk about impairment, it's only a reduction in the value of the assets. Okay. All right, that is one. So every financial asset should be impaired? No. There are some assets which you need not impair. One, if you're valuing financial assets under FVTPL category, you need not impair that. If you have an equity shares as financial assets, and on that, if you're going for FVT OCI method, this is an irrevocable option. Okay. Normally impairment loss goes to SPL, but this is an irrevocable option, no? And this irrevocable option says that you have to book the gain loss in OCI itself. But impairment gain loss goes to SPL. So there is a contradiction. Hence they said, if you have any equity shares as financial asset on which the company has adopted irrevocable option of FVT OCI, then on such asset also you need not do the impairment check or impairment test. On all other assets, financial assets, you have to do the impairment check. When you do impairment check, you may get some impairment loss. There could be two types of impairment loss. One is your lifetime expected credit loss. Other one is your 12 months expected credit loss. Okay. And how do you find out this loss? Check how much you have to recover from that particular financial asset and how much you can recover. If you have to recover 1 lakh from that financial asset, suppose in year 1, and if you can actually recover only 80,000, that means 20,000 is a loss for you. Okay. Like this, if your financial asset spans for 3 years, means find out this. All this loss will be on a future value terms. Find out the present value of it. This is the total loss on full instrument. That we call it as lifetime expected credit loss. Or if company doesn't want to go for lifetime, there is another option to book the 12 months expected credit loss itself. Okay. So when to go for lifetime, when to go for 12 months. Simple rule is for every financial assets, if company wants, they can apply lifetime only. And for few assets, lifetime ECL is compulsory. Meaning if you have any short-term assets like trade receivables, etc., applying lifetime ECL is compulsory because their life itself will be lesser than 12 months. That's the reason they said by default apply lifetime ECL itself. If any financial asset is credit impaired or if there is a significant increase in the credit risk, for such financial assets, you have to compulsorily go for the lifetime ECL itself. And when can you say asset is credit impaired? If there is any indicator like he has breached the contract, he's facing financial difficulty, okay, he's filed for bankruptcy, his market share is getting reduced, etc., etc. If these sort of indicators or evidence has come, means we could say financial asset has got credit impaired. For such credit impaired financial asset, we have to go for lifetime ECL itself. For others, you can go for 12 months ECL or lifetime ECL at company ka choice. All right. This is about impairment loss. Fine. And impairment loss, if you want to get 12 months ECL, I had expressed you in formula itself. You take the loan amount, take the financial asset ka loan amount, multiplied by loss given percentage. Okay. And multiply by 12 months ka POD percentage. If they want 12 months ka ECL means they will give you 12 months ka probability of default percentage. Apply that. That you will get the simple formula. You will get the answer in one-liner answer. Okay. But they've also brought in some practical expedient. What they brought in is for debtors and all. Debtor is a financial asset. Before this standard, anyway, debtors we used to make provision for doubtful debts. That we used to make it based on our age-wise report we used to get. Debtors due for how many? 1 to 30, there is 1 to 30 days, 30 to 60 days, 60 to 90, like this we used to get age-wise report. Based on that age-wise report, we used to make provision for doubtful debts before. The standard is saying, if you don't want to do all this drama, you are anyway booking provision based on your provision matrix, based on that age-wise report. You can book the impairment loss using that itself. No need to do extra calculation. No need to do all this drama. You can book the impairment loss based on that age-wise report itself. That is one of the practical expedient or practical relief brought in to those assets. That's about impairment. All right. Next is regular way purchase or sale of financial asset. What does this regular way purchase means? One, it should be a contract to purchase or sell financial asset. This requires delivery, and that delivery should be within a particular time frame, and the time frame should be regulated by a particular authority or a marketing convention. These are the 5 features of regular way purchase. If it's a regular way purchase transaction, then you can go 2 types of accounting you can follow: trade date accounting or settlement date accounting. Trade date accounting means if a buyer is buying financial asset, he will record that financial asset on the trade date itself. The seller also will derecognize that financial asset on the trade date itself. Okay. So on the settlement date, subsequent measurement will be as per that method chosen. If you are going for ACM method for that financial asset, subsequently there is nothing. Matlab, you go for ACM table and account it. So fair value gain loss, you ignore it. Okay, like that. Fine. If you're going for FVTPL method, then subsequent gain loss you need to record. However, if you're going for settlement date accounting, then on the trade date, on the contract date, no journal entry will be passed. Between trade date and settlement date, if your year is already ending, then on the balance sheet date, that's what I mean by that. For ACM, there is no accounting because we don't give importance to fair value in ACM, this thing. If you're following FVTPL or FVTOCA accounting, then there will be a fair value changes because you would have agreed the contract to buy it at for 1 lakh. Fair value could be 1.5 lakh. So there is a fair value gain of 50,000 here. And fair value gain loss alone should be recorded on the balance sheet date. That's what we have given. This will be done only by the buyer. Seller will not record this because as far as seller is concerned, he's not concerned with fair value. He's only concerned with two things: carrying amount of the asset, selling price of the asset. Only those two things he'll compare and book his gain loss. This fair value gain loss and all he'll not book. Okay. On the settlement again, do the same comparison. On the settlement date, what is the fair value and check how much have you shown with. Accordingly, that fair value gain loss will be accounted. But for ACM, we don't have to worry about fair value. Okay. So if you're doing settlement accounting and if that asset is accounted under ACM method, you will record such asset at transaction price itself, not the fair value. Meaning if you have agreed to buy the asset at 1 lakh, under ACM method, you will record on the settlement date this asset at 1 lakh itself, like that. But under FVT method, we have to record it at fair value. So you record it at fair value and any gain loss, transfer it to OCI in case of FVT method, transfer it to SPL in case of FVTPL method. Okay. All right. So this is the thing about regular way purchase. Then derecognition of financial asset. When will you cancel financial asset? One, if your contractual right to receive the cash flow has expired. When will it expire? Let's say we have a financial asset debtor 1 lakh. If debtor has paid us 1 lakh means still can we collect the money? No, the right to receive the cash flow has expired. So derecognize. That is one provision. Or if we have waived off that asset, we are being Garala Prabhu and told the debtor we don't want your money. Or he only put Tirupati toss to us, bad debts. So in those cases, derecognize. Okay, that is first case. Second case, contractual right to receive cash flow has not expired, but the right to receive cash flow you have transferred along with significant risk and reward. If you have transferred the risk and reward on that financial asset, then you can derecognize. When, under what circumstance you could say, if you want to say significant risk and reward has been transferred, one, the sale should be unconditional. The seller should not put any condition relating to that financial asset, meaning you should not use it for more than 5 hours. You should not sell it to somebody. Like this, some condition should not be put forth by the seller to the buyer. That is one. If you are selling with any repurchase option, no problem, you can have this repurchase option, but that repurchase price should be the fair value on the repurchase date. It should not be at a fixed price. You should be able to repurchase it at a fair value on that repurchase date. If that is the case, today itself you can treat it as sale and derecognize it. When you buy back later at fair value, record it as separate purchase. Or the other choices, you have sold a financial asset with a put option, call or put option. Then you can derecognize financial asset provided that call or put option should be deeply out of the money, meaning for the person exercising it should be a loss. If it's a loss means he will not exercise. So this call or put option should get lapsed. Only on that circumstance you can derecognize the financial asset. Okay. All right. However, if you have sold any financial asset with a repurchase price, but that repurchase price is already fixed, or if it is sale price plus interest or sale value plus lender's return, in that case, no, it is not considered as you cannot do the derecognition of financial asset. We saw this now, all this in the problems, right? All these are problem pointers that I brought in here, right? Or if you have sold a financial asset with a call or put option, and if that call or put option is deeply in the money means for the person exercising it, it is a profitable, then definitely he will exercise. Okay, so that means you cannot treat or you cannot apply derecognition the provision. And also when no control has to be retained, you can say seller should not have any control over that financial asset. You can say seller has no control over this financial asset provided the buyer of that financial asset can do whatever he wants with it, meaning he can sell it to any unrelated third party. There should not be any seller interference into it. That's when we say no control is retained. Okay. Then you can't do partial derecognition. Can you also do just like full derecognition? Can you also do partial derecognition? Yes. If you have sold interest strip separately, like if you invested in bonds, so that means bond is a financial asset. On that bond, you will get interest and also you will get principal. This interest portion alone, we call it as interest strip. If you have sold this interest strip separately, you can derecognize this interest strip alone, not total. Only interest strip portion of financial asset you can derecognize. If you have sold interest strip partially, let's say to the extent of 80% or 90%, then to the extent of that 80 or 90% which you have sold, to that extent you can derecognize. If you have sold principal and interest partially, let's say 90%, then to the extent of 90%, principal and interest can be derecognized. However, if you're selling financial asset up to a particular tenure, let's say the tenure of financial asset is 6 years, you sold the cash flow rights only for 4 years, meaning for the first 4 years, the cash flow on this asset somebody else will receive. Year 5 and year 6, you will still receive. That is not considered as partial derecognition. Or if you're giving a right over cash flows, first right over cash flows, second right over cash flows to somebody else, meaning first cash flows on this instrument somebody else will get, then I will get. That giving that priority and all is not considered as a derecognition of financial asset. All right, next one is securitization arrangement. Securitization is an arrangement where the banks generally transfer the loan to a trust called SPV. So the loan amount will be huge. So the SPV will convert this into a smaller units and sell it to the investors. And investors will pay back the money, which will be given back to the bank. So this is the process through which illiquid assets will be converted into a liquid assets. So the question is, bank has given a loan to the customer. So it is a financial asset. So when they do this SPV arrangement, can we derecognize that financial asset of the bank? You can do so provided 3 conditions are satisfied. 1, we should not have any obligation to pay to the investor, okay, unless we receive the money from EMI from the borrower. And 2, once we receive the EMI from that borrower, without material delay or significant delay, we should give this money back to the investor. And 3, we already transferred this loan to SPV. Once more, we should not be in a position to sell or pledge the same asset. If 3 conditions are satisfied, then you can go ahead and derecognize that particular financial asset. Otherwise, no. What are if the transfers does not account for derecognition, like factoring arrangement? If you are making a factoring arrangement with recourse, that means what? If debtor defaults, factor will come back to you and collect the money. So that means risk and reward is not transferred. So can you derecognize debtor? No. But factor would have paid you some money when we entered into this factoring arrangement. So that you will simply treat it as a loan. So if you can't derecognize financial asset, financial asset accounting will still continue as usual. Whatever amount you have received as part of the sale transaction, that you will show it as loan, and for that loan you apply ACM accounting. Fine, like that. If you have done a factoring arrangement without recourse, that means bad debt risk is with the debtor only. So risk and reward both you have transferred. In that case, you can derecognize. All right. Next, we saw continuing involvement in involved asset. Continuing involvement in transferred asset. This is a scenario where neither significant risk and reward we have transferred, nor significant risk and reward we have retained. Somewhere in the middle we are. Neither retained fully nor transferred fully. That scenario. In that case, simply you need to pass one journal entry. That is bank account debit, continuing involvement asset account debit. This continuing involvement asset account will be accounted at the carrying amount of the financial asset or the guarantee amount, whichever is lower, to financial asset account to associated liability account. This is a journal entry you will pass, and associated liability will be recorded at the guarantee amount and fair value of guarantee both put together. Any balancing figure, you will transfer it off to P&L. Meaning you have involved in this asset. Normally, in these sort of things will happen and factoring arrangement where you also give some extra guarantee to the factor. Meaning if debtor defaults, I will give you some extra guarantee like that. That means risk and reward on the original asset you have transferred, but you took some extra obligation of guarantee on your head. So that's the reason we account one asset called continuing involvement asset account. Since we have given guarantee, we have to record one liability also. Fine. These two will be shown at the same value. Okay. All right. Next is derecognition of financial liability. When can you derecognize financial liability? When obligation is satisfied. Financial liability means we have an obligation to pay. If that obligation to pay is satisfied, if you already paid cash to your creditor, or if you're giving some other financial asset to your creditor, that means that obligation is settled. If the obligation is settled or if the obligation is waived off, creditor told I don't want the money, if waived off, or he gave some discount. In those cases and all, you can derecognize the financial liability. So if there is any balancing figure on this transaction, that goes off to SPL. All right. Next, we saw debt restructuring. Debt restructuring is an arrangement wherein some old terms of the loan, we have taken some loan. So due to some financial difficulties, original terms we are not able to honor. So we are approaching the bank and asking to change some terms. That only we are calling it as debt restructuring, wherein some old terms have been changed and some new terms has been brought in. So since this new terms has been brought in, we need to check whether these new terms are substantially different or not. First, you need to check that. How do you check whether it is substantially different or not? For that, we need to compare two things. One, we want financial liability ka balance on the modification date or on this alteration date. Okay. Then second, find out the present value of cash flows under the new terms, but discounted at the original effective interest rate. So you'll get a difference. Using that difference, find out the difference amount. Or using the difference amount, find out the different percentage. If the difference percentage is greater than or equal to 10%, then we say it is substantially different. Sir, if it is substantially different, what we have to do? If it is substantially different, you have to go for extinguishment accounting, else we'll go for modification accounting. Extinguishment accounting means old financial liability will be cancelled and new loan will be brought in. Okay, you will treat that old loan has been repaid and new loan has been brought in, and that sort of accounting will follow. And when you pass old liability, you need to cancel means you will debit, new liability you will credit. So entry may not match. If there is any balancing figure, that is your derecognition gain or loss, gets transferred off to SPL. At what value will you measure the new loan? If this new loan cut terms, if it was done at market terms on the modification date, then how much over principal was outstanding, that itself becomes your new loan ka value. However, if this new modification, if it was not done at market terms, then again it becomes off market wala transaction. Again, you need to find out the present value of cash flows under new terms discounted at the market rate. That value becomes your new loan ka value. Again, gain loss ka difference. Any difference between this entry is a gain loss, gets transferred off to SPL. On this extinguishment accounting, due to this modification, if you have incurred some cost like legal fees, professional fees and all, it is not considered as transaction cost, meaning those costs will go off to SPL itself. Okay. If you're going for modification accounting, what will happen? You will not cancel the old loan. Old loan ka accounting will still continue. Old liability ka loan. But you might have incurred some fees like legal fees. That will be considered as transaction cost and reduced from the financial liability ka balance. And since the new terms have changed, your original EIR will not hold good. You'll have to find out the new effective interest rate. Okay. Effective interest rate is simply a rate at which present value of cash inflow will be equal to your present value of cash outflow. So find out the new effective interest rate and prepare the new ACM table as per that new EIR and do the accounting, same accounting, book the finance charges and record the repayments, etc., etc. All that accounting is still the same. Just that new EIR will come into picture there. Okay. Then we saw debt for equity swaps. Debt for equity swaps is an arrangement wherein some debt you are settling, liability you are settling. How? By giving equity shares. Since you are giving equity shares, you have to record this transaction at thumb rule at market value of equity shares. Okay, fine. All right. If market value of equity shares due to some reason, if you're not able to find out, then use the financial liability ka market fair value itself and record it at that value itself. Okay, and when you record this entry, if the shares are issued at premium means record the premium in securities premium. Still, if the journal entry is not matching means the gain loss will be transferred off to SPL account. That's your debts for equity swap accounting. Okay. Then we went to derivative. Derivative means it's a contract which has three features. One, that particular contract does not have any value. Its value will depend on an underlying or underlying asset. That underlying asset could be anything. It could be your financial asset, non-financial asset, anything. And two, initial investment is either less or on the lower side. Three, settlement will happen at a future date. And this settlement could be a gross settlement basis or a net settlement basis. Normal types of derivative financial instrument that we see is forward, futures, option, swap, etc., etc. For forward, futures and swaps, there will not be any fair value on the contract date, hence no journal entry will come. However, for options, you will receive some option. One guy will pay the premium, one guy will receive the premium. That premium element represents fair value and we pass the journal entry to the extent of premium. For the guy paying the premium, he will pass the journal entry derivative financial asset account debit to bank. For the guy receiving the premium, he will pass the journal entry bank account debit to derivative financial liability. After that, henceforth, for that derivative financial instruments, we do FVTPL accounting. Only one method allowed, that is FVTPL. So find out after that, on the balance sheet date or settlement date or whatever, each reporting period, record that asset using FVTPL method, meaning find out the fair value gain or loss. If it's gain, book it as derivative financial asset. If it's a loss, book it as derivative financial liability, like this. And gain loss will go off to SPL itself. Okay, that's one. Then we saw embedded derivative. Embedded derivative means it's a normal contract relating to financial asset, financial liability or non-financial assets. But these contracts have some derivative features. They got bundled with derivative. They're not full-fledged derivative. Some derivative feature is included in them. Okay, that's one. Now check this embedded derivative is included in which contract. Okay, one, see if financial asset is embedded with derivative. If financial asset is embedded with derivative means you do not separate the host. Host we call it as that original contract. Original is your financial asset. And then embedded derivative constitutes your derivative component. Okay, the host and derivative you need not separate if financial asset is clubbed with derivative, because normally if these sort of features are attached means CCF test on that financial asset will fail. Anyway, that host will be accounted under FVTPL method itself. Hence no need to separate. Treat it as one contract and account them under FVTPL method itself. However, if financial liability or non-financial assets have some derivative feature, if that is having embedded derivative, then check are they closely related. If they are closely related, then no need to separate it. Treat them as one and account it under FVTPL method. If they are not closely related, then what you have to do? Check is separation possible. Practically is it possible to separate them. If it's possible to separate it, no problem. If you're not able to separate it means no need to separate them. Treat it as one contract and account it under FVTPL. If you are able to separate it, then check is the host, meaning your financial liability or non-financial asset, that we calling it as host. Check if the host is already accounted under FVTPL. Because for derivative also we use FVTPL. If host is already accounted under FVTPL, then no need to segregate them. Treat it as one contract and recognize it FVTPL itself. Now, if host is not accounted under FVTPL means then you need to separate, and host is accounted as per respective Ind AS and derivative is accounted as per FVTPL method. All right, then you could have some foreign currency embedded derivative. Foreign currency embedded derivative generally comes in these scenario. Two entities are there in India, but billing is generally done in dollars. That means what? Ideally, the billing should have been in Indian rupees, but now since they build it in dollars and dollar value fluctuate, and dollar value fluctuates based on the forex and other country ka risks, returns, etc., etc. So you bought some unnecessarily extra risk on your head, fluctuations on your risk. That represents your embedded derivative. So if you have any foreign currency embedded derivative, the question was, should we separate the host from embedded derivative or account them? In these sort of transaction, since both are in India, since the billing was in dollars, they are not closely related, so you need to separate. So same goes another example as well. You are in India, another customer is in Europe, but still the billing in dollars. This also normally we don't see, because either the billing should have been in Indian rupees or European currency, but the billing happened in dollars. So in these sort of transaction also, they'll be treated as not closely related and they'll be separated. Okay. However, if you are an Indian entity, your customer is in there in US, so his dollar is in functional currency, and you bill it in dollars. These sort of things is a normal occurrence. In that case, you can treat them as closely related and need not separate it. Okay, that's one. And we also saw extra features. Excuse me. If you have any debenture interest that is linked with equity index. Okay, so your company has issued the debentures, but how much you pay interest on those debentures is linked with equity performance. Okay, in that case, there's some derivative features, because how much interest you will pay will be based on equity. If equity price is good, means maybe you will pay more interest. Equity performance is bad, means you will pay less interest. That means there is a fluctuation, there is a derivative feature in this contract. Yes, so these are not closely related contracts, so you need to separate them. If you have any pre-closure in a pre-closure option in the loan, that pre-closure option as a thumb rule, we treat it as not closely related. However, if you see a couple of options, you'll treat them as closely related. One, if the company compensates the present value of lost interest to the investors, that is one. And two, if the exercise price approximates your financial assets ka closing balance. In that case, they'll be closely related. Else, they will not be closely related. If they are closely related, you do not have to separate them. Otherwise, we need to separate them. Okay. Excuse me. For foreign currency embedded derivative, you need to separate it, especially in these scenarios and all. For that, there are some separation rules. What are those separation rules? One, you'll account the host. You'll account the host using the contract duration ka forward rate that will be provided to you in the problem. So record the host using that particular rate. The derivative here generally will be your forwards of futures, etc., etc. So they will not have any fair value. So on the transaction date, you need not do anything. Subsequently, on each reporting date till the settlement, derivative ka fair value we found out. If there is a fair value gain, means book it as derivative financial asset. If the loss, means book it as derivative financial liability. Same goes for your reporting period till your settlement period, same drama. Okay. And these are notional accounting. You have not actually entered into any derivative contract. That means on the settlement date, there will not be any gross or net settlement for your derivative. The only way to close this derivative is to transfer it to the host. And the host here refers to not your, because here host contract will have two components. One will be your financial instrument component. Another one will be your non-financial instrument component. Okay, meaning you purchase the goods. If you purchase the goods, means the journal entry will be purchase account debit to financial liability creditors. Financial liability creditors is your financial instrument wala component. But when you purchase, that is more related to inventory. Inventory is non-financial asset component. So when you transfer the derivative financial asset, no, you will transfer it to the financial instrument component of the host, not to the other one. Okay. Other one, whatever you recorded initially will stay as it is. So record the derivative to the host component of financial instrument host component, and then that derivative will get closed. Fine. And then accordingly, if you have settled that financial liability, means past settlement entry. The non-derivative component, meaning your inventory related one, initially you already recorded at contract duration ka forward rate. So no need to subsequently remeasure it. Same thing, it will be accounted under. Okay, that's what is your this component this para is trying to say. Next is your disclosure aspect. Disclosure is easy. 3 methods of financial assets, disclose that. Two methods of financial liability, ACM and your FVTPL, disclose that. If you have any impairment loss, disclose it. If you have any compound financial instruments, disclose it. Offsetting, all these are some disclosure aspects. Remember 3 to 5 I told you just to be on the safer side. All right. Then we lastly looked at hedge accounting. Hedge accounting means it's an activity. Hedging means it's an activity done to cover the risk. The risk could be associated, or risk could come from a recognized financial asset, or from a recognized financial liability, or highly probable forecast transaction, or from a firm commitment. So you can do a hedging activity from any of these. Okay. In hedging, we see two terminologies. One is the hedged item, another one is hedging instrument. Hedged item is that component which has a risk or which is exposed to risk. Hedging instrument is that activity that you're doing to cover that risk. Hedging instrument is basically a derivative financial instruments like forward futures, etc., etc. Okay. All right. For you to do hedge accounting, one hedge should be effective. And when can you say hedge is effective? ECR should be satisfied, meaning there should be an economic or monetary relationship between HI and HHI. And C, the credit risk should not be dominant, like factoring. Okay, meaning credit risk means default. Because of default, you should have not gone into hedging. Okay, that should not be there. If that is the case, means you cannot follow hedge accounting. Or the hedging ratio should be based on the actual quantity of risk. All right. So this year, if ECR is satisfied, means you can say hedge is accounting, and if hedge is effective, you can follow any of the three types of hedging. Now, one is the cash flow hedge accounting. When will you follow cash flow hedge? You have a cash flow variance risk. How much cash flow you will receive, you're not sure. That is varying. So to mitigate that, if you're doing any hedging, we call that as cash flow hedge. And simple cash flow hedge ka rule is what? The gain or loss on the hedged item and hedging instrument from the transaction date till the settlement date, whatever gain loss you have, you park it in cash flow hedge reserve, on OCA. Okay. And on the settlement date, the cash flow hedge reserve will be transferred off to SPL. That's all it is. Fine. And then it's your fair value hedge. When will you go for fair value hedge? If there is a value change risk, suppose you buy equity shares of a foreign company. The equity shares, if it is traded, means its value could change. So to cover that value change risk, if you're doing any hedging, then we say you can apply fair value hedge accounting. The fair value hedge ka simple funda is the gain or loss on hedged item and hedging instrument. Everything will go off to SPL. But one item, no, it's irrevocable. If you purchased equity shares of another company, and if you're going for FVT OCI method for such equity shares, it is irrevocable option. But for derivative, you have to use FVTPL method. So, but hedging accounting means hedged item and hedging instrument has to be accounted hand in hand. You cannot follow different treatments. You have to follow one treatment. Since you cannot, this is irrevocable, so you cannot change that. So derivative accounting only you change, meaning gain loss on both here will go off to OCA. That way. Next is hedge of net investment in foreign operation. If you have any foreign subsidiary ka share price also could change. So to cover that risk, if you're doing any hedging, we call it as hedge of net investment in foreign operation. If it's effective portion of the hedge, then the gain loss will go to an OCA, and the name of the OCA is FCTR, Foreign Currency Translation Reserve. Okay. Ineffective portion will go to, from FCTR, it will go off to SPL. Effective portion means as long as you have that foreign subsidiary, the gain loss you book it in FCTR. Okay. The moment you sell that subsidiary, we say the hedge has become ineffective. So if you have sold that foreign subsidiary, then from FCTR, it will move up to SPL category. Okay. Yeah, this was your quick revision covering all the concepts of financial instrument topic. Hope the session was helpful to you. Thank you.